By the end of this video, you'll have a better idea of how to build a tax-efficient portfolio, what type of investment accounts you should use, what type of investment strategies will help you accomplish this goal. Lastly, if it even makes sense for you to try this out. How's it going, everybody? My name is Mike the CPA, and on this channel, our focus is covering taxes and investing. I asked all of you, what type of investment video did you want to see next on this channel? And building a tax-efficient portfolio won just by a nose, as you can see from this YouTube poll that we took last week. And here's a 3D version of that same poll. As we cover this investment topic today, I want you to think of investments as some are going to be more tax efficient and other investments are going to be less tax efficient. What is a good example of something that is highly tax efficient? Usually it's an investment that you can invest in that does not generate a lot of cash flow for you, because cash flow and income usually generates more tax. Whereas something that is less tax efficient, the opposite is true. If it generates a lot of cash flow, a lot of income, generally those investments cause you to pay a lot of tax. And I gotta show you this, guys. Take a look at how big the tax savings can be for you if you invest in a tax efficient manner. Investing a certain way can save you 15, 20, or even up to 40% in some cases. And we're talking just federal taxes here, not even talking state taxes. If you throw state taxes in the mix, you might save up to 60% just by investing in a different way. Now just think about that for a second. What if every dollar you earned when you're investing, you could save an additional 15 to 20% and keep that in your pocket rather than giving it to Uncle Sam? Wouldn't that be amazing? Well, that is what tax efficient investing is all about. Besides, have you even met Uncle Sam? Uncle Sam is abusive with your money. He takes it from you and spends it however he pleases. He's the uncle you don't want over for Thanksgiving dinner. What I would like you to do right now, just besides hitting that like button, of course, is listen carefully to these different tax strategies and figure out which ones could easily fit into the way you are currently investing right now. Now, please don't feel that you need to turn your entire portfolio upside down, change your investing strategy, change your marital status, and all this and that in order to save on taxes. Nope. You don't need to do that. As an investor, if you're trying to be tax efficient, which is what we're talking about here, I think the bigger challenge is trying to manage your need for cash flow versus tax savings. Now, the reason I bring that up is we're talking about these tax deferred accounts, and you probably already know this. In fact, I'm sure most of you do, but you cannot really access that money without very steep penalties until you reach the age of 59 and a half. So if you want to retire basically any time before the age of 60, let's say, just keep it simple, like in your 30s or 40s or whatever, you do not want to have most of your money trapped over here in these tax deferred accounts. What would probably work better for you in that case, if that's your goal, is to have your money in a taxable brokerage account. Pay some taxes as you go, but at least you'll get the cash flow you want being generated over here, and you're not going to be penalized if you access that money versus being penalized if the money is put in one of these tax deferred accounts. Now, this is the part where I get to show you examples on screen and talk about the different types of investment accounts you can use to do this. We're going to be talking about the accounts like the normal brokerage account, the traditional IRA, the Roth IRA, the 401k, and the all glamorous Roth 401k. There's way too many friggin' accounts. All right, you all ready to play the matching game with me? We're gonna match up the way in which you like to invest, the type of investments you like to invest in, with the right type of investment account to maximize your tax savings. Okay, raise your hand if your favorite method of investing is short-term trading. This one's for you. And let's just cover it within a taxable brokerage account real quick. Let's say that's your preferred account choice. The beauty of doing short-term trading in a taxable account is that if you have losses, you can actually offset the gains with your losses. This is something you cannot do in tax deferred accounts. In other words, you actually get a tax benefit when you lose money in a taxable account, but you do not get a tax benefit if you were to lose money in a tax deferred account. But be careful with trading in and out of the same stock over and over again, because that can generate wash sales. And if you generate wash sales, what that's going to do to you is it's going to disallow you that loss deduction. And therefore, all the profits you made from that stock, you're probably going to be subject to tax on, because you cannot use the loss due to the wash sale. So watch out for that. As a CPA, I've seen some pretty mean wash sales in my day. With a tax deferred account, when you're doing short-term trading, you don't have to worry about wash sales. And even if you're doing it in a traditional IRA and not a Roth, the money's going to come out at the same tax rate. Because if you're being taxed at short-term rates in the taxable account, the same tax rate's going to be applied to you in the traditional IRA. So you might as well invest as much of it as you can in the traditional IRA, as long as you don't mind accessing that money after age 59 and a half. You can grow your account to quite a substantial balance if you're not paying taxes the whole way through, and you're getting a tax deduction when you contribute money to those accounts. So don't forget that. But of course, of all the account types with tax savings, I would actually do your short-term trading in a Roth if you can, because yeah, you pay the money up front, the tax up front, but whatever you can grow that account balance to over the course of your lifetime, all of it is yours tax frickin' free, and there's nothing superior to that. Okay, dividend investors, no need to be jealous of those short-term traders. Now it's your turn. Traditional IRA is okay for dividends because you're going to get the tax deduction when you put the money in, but you're going to lose the benefits of the capital gain tax rates if you put that money in a traditional IRA, which is why I generally don't recommend it. So that's why I would go with a Roth, and then I would secondly probably move on over to the taxable brokerage. The taxable brokerage account with dividend paying investments. It depends on how hard you want to go with this. If you really want to generate the least amount of tax, you don't really want investments that pay dividends within your taxable account. However, if you do want some cash flow, the good news is the taxable brokerage account allows you to get qualified dividends. If you don't know what capital gain tax rates are, I got multiple videos that you can check out. You can nerd out all day on that stuff. I'll leave links to those videos below. You want to be tax efficient with dividends? My recommendation to you is the first place you should start is your Roth IRA, especially with those dividends that produce the highest yields. Your 4, 5, 6, 7, 8, 9, 10% yields. Those for sure you're going to want in your Roth coming at you tax free. So that's where I would start. But let me reiterate, you want your highest yielding dividend paying investments in your Roth and your lowest paying dividend investments in your taxable brokerage account. That's how you will want to structure this for tax efficiency. Your taxable brokerage account is most tax efficient when you don't have a lot of other forms of income, when your wages are low, when you have not a lot of Social Security and business income, things like that. All those things are going to keep your overall tax rate low, which is going to lower the amount of tax you pay on ordinary income and even further lower the tax you pay on capital gain income. So if you can look poor on paper, but you're making dividends, you can get away with paying hardly any tax on a sizable amount of income. And there's no other video on my channel that I think illustrates this better than my video on wages versus dividend income. And watch that video and see how differently your wages are taxed versus how your dividends are taxed. All right, growth investors, I see you back there, and you've been waiting for this. We talked about our short-term trading, we talked about our dividend cash flow investors. Now it's your turn. Where is the absolute best place to invest for growth? Well, it's in the Roth. Yeah, you guessed it, the Roth again. The Roth is just too studly. Now, if for whatever reason you don't have access to a Roth 401k or Roth IRA, then I think the next best place to invest for growth for tax efficiency purposes is the traditional IRA or traditional 401k. Although I haven't talked a lot about the 401k yet in this video, you do get tax deferred growth and you get a tax deduction when you put the money into these type of accounts, which is really nice. And with tax deferred growth, your money can grow to a substantially large amount over the long haul. As you know, the downside is though, you have to wait until 59 and a half to really access that money. And the other downside, besides the fees you pay on those investments, the money, when it comes out, when you take a distribution, you actually have to pay tax on it when you start to take the money out, based on whatever your tax rate is at that point in time. So those are some of the downsides. But another positive attribute of a 401k, for example, is an employer match. So if you put money into your 401k and your employer matches that contribution, that's effectively a 100% return. And so in my opinion, that easily outweighs any fees you pay right there, as long as you're getting a match. So to the extent you're getting a match, I would say I would use the 401k. If you end up investing for growth in a taxable account, that's totally fine too, because although you're going to pay tax on that appreciation as you sell off those investments, the good news is, as long as you've held that investment for more than a year and 1 day, it's considered long-term. And when you have long-term sales, you get taxed at capital gain rates instead of ordinary income rates. So capital gain rates, as you know, are always lower. And so there's some tax benefits there if you do this growth type of investing strategy within that type of account. Now let's talk about specific type of investments that you may want to invest in. If you have tax-exempt bonds, the only place I would recommend putting those is in the taxable account, because that's the only place you're really going to benefit from holding those. You're not going to really benefit from those if they're sitting in a tax-deferred account, because they're already tax-exempt, and you don't want to use up your limited space in those tax-deferred accounts for that. You might say to me, Mike, I want to invest in publicly traded partnerships and MLPs. What account should I use to invest in those? And to you, I would say use the accounts such as the IRA or Roth IRA. A lot of those investments are strictly business type of investments, meaning you actually get a K1 statement from that partnership. The income items on that K1 are going to be taxed at ordinary income rates. You're not going to be able to get qualified dividend treatment, capital gain rate treatment most of the time from publicly traded partnerships. So stick that over in the tax deferred accounts. Because when it comes to publicly traded partnerships, if you have those held in a taxable account, you're going to get a thing called a K1 statement, and it's going to vastly complicate your taxes. And if you're somebody who takes your taxes to have them done by a CPA or an enrolled agent, they're going to have to charge you a lot more likely, because it's going to take them a lot more time to prepare your tax return. And often that $20 or $30 a year annually, I see most people get from these things, because they don't really have a lot invested most of the time, is greatly outweighed by the larger accounting fee bill they have to pay. So really, the investment as a whole is a loss when they take into account their extra accounting fees. So it's really not a good idea, in my opinion, to put those in a taxable account. Now, you want to invest in REITs or real estate investment trusts, that's fine. But if you want to be tax efficient with those, the only place I would really put those is place them in your Roth IRA. And if not the Roth, I would say traditional IRA. 401k is fine too. The reason is that income, those dividends that are paid out through REITs, is taxed always at ordinary income rates regardless of the circumstances, which is why it really doesn't benefit you at all to put those in your taxable brokerage, at least not from a tax standpoint. People put them there because they usually provide more cash flow, but from a tax standpoint, it's not a good move. For corporate bonds or high-yielding bond funds, I would say the exact same thing as I just did for REITs. Place those puppies over in the tax-deferred accounts. Now, this might surprise you guys, but if you want to pass along assets to your heirs, what is the best account to use? Well, believe it or not, it's actually the normal taxable brokerage account. And the reason I say that is because those investments in that account, when you pass them along, they get a step up in basis to the value it is at your date of death, which allows them to sell that investment and pay very little tax because they have a much higher cost basis. So that's the beauty of passing along assets in a taxable account. So don't forget that. Okay, hopefully you just learned a lot about tax efficiency. So in summary, taxable brokerage accounts are great because they allow you to harvest losses against your capital gains. They allow you to take advantage of capital gain tax rate as long as you hold your investments for more than a year and 1 day before you sell them, or if you hold your dividend paying investments long enough, they'll give you qualified dividends instead of ordinary dividends, which overall saves you a lot in tax over the course of 30 or 40 years. Traditional IRAs are good when you need a tax deduction right now, and that money can grow tax deferred. But the downside is when that money comes out, it's going to be taxed at whatever your ordinary tax rate is at that point in time. Clearly, Roth IRA or Roth 401k is the golden standard when it comes to tax efficient investing. Yes, you get taxed right now before you put the money in. However, all the growth, all the dividends, or all the capital appreciation, when you take that money out, it's all 100% tax-free, and there's just nothing that beats that. It's absolutely the best. Now that you've been armed with all these tax-efficient investing strategies, the thing to do going forward is, before you invest your money, think about which account you should invest that money in and what type of investment you're investing in, and match up the right account type for that investment. And if you do that over the course of your life, it's gonna save you a lot in taxes. It's gonna save you tens of thousands, even hundreds of thousands of dollars over the course of your lifetime, especially if you invest consistently. Now, at the beginning of this video, I said don't restructure everything just to save on taxes. It often does not make sense. You have to weigh how much cash flow you want versus tax deferral or tax efficient investing. It's a trade-off, right? If you want to retire early, remember, you gotta pay some tax. There's really not that many ways around it. It just is what it is. So don't be afraid to invest in a taxable account. I do personally, even though I know it's gonna cost me some tax. Having the cash flow and flexibility makes me feel good, and if I really need the money, at least I can access it any time, versus having the money locked up until I'm age 60, right? So it's a trade-off, and that is a thing that you're gonna have to balance throughout the course of your life, throughout the course of your investing career. All right, guys, to be honest, I'm pretty tired after making this video. Lots of work went into this. I really hope you enjoyed it. See you down in the comments, and I hope to see you in the next video. Peace.